Good morning, everybody. Scott Gegerson, Certified Financial Planner and President of Truvium Wealth Management. I wanted to take some time in today's segment to discuss what we're seeing from a lot of our clients and questions that we get asked about the rate hikes that the Federal Reserve Board has been imposing over the last couple months. Certainly a very rapid increase as it relates to past interest rate cycles. And really, what does that mean? What does that mean for overall rates? What does that mean for portfolios? What does that mean for debt? And really, what does that mean for your lifestyle? So I wanted to address a lot of these things today from an economic perspective. I have a special guest that we're going to invite to talk a little bit more about this and hopefully shed some light for you folks. So how did we get here, and why is inflation so high right now? Certainly the Fed has declared war on inflation. And what does that really mean? Why are they raising interest rates so fast to combat inflation? Well, on the aftermath of the pandemic, where much of the world's population were stuck in their homes, we weren't spending money. We were saving a tremendous amount of money. Now that era is predominantly over, we're back to somewhat normal spending habits. And what that's doing is we have a high demand. The world's economy has a high demand for consumer goods. However, there's still some significant supply chain constraints with some additional factors as well. I mean, certainly China's zero COVID policy does not help supply chain. The war in Ukraine does not help supply chain. So what does that mean? Well, Economics 101, whenever there's a high demand but a low supply, that's going to drive prices up. We've seen it with autos over the past year. I know clients that have tracked their vehicle on shipping containers leaving ports in Asia and Europe to come over here, and the number of months it's taken to get those cars. Because there's a low supply of those vehicles, it's driving prices up. Now, the Fed will win this war on inflation. It will come back to target inflation rates of around 2 to 3%. However, it's going to take some time. An economy is not a light switch. You can't flick it on and off. An economy is like a 85-car long freight train that it takes miles and miles for this thing to either speed up or slow down. So we're going to see some short-term pain, but again, the Fed will win this battle against inflation. It will come down, and we will see other things happen as a function of that, such as capital markets and equity stock prices will start to rebound. Companies will start to make more money. They'll start to be in a growth phase as opposed to a contractual phase. And the average consumer will start to see that in our portfolios, in our spending habits, and things of that nature. So I'm here with one of my closest friends and strategic partners, Chris Roberti, Retail Producing Manager at Cardinal Financial, aka Mr. Mortgage. Chris is obviously very well in tune with the real estate market, interest rates, and really what that means for the average consumer. We share a lot of clients and they have a lot of the same concerns. So what we want to do today is talk about where interest rates are, where they're going, and what does that really mean for everybody. Okay, so Chris, thanks for being here.
Thanks for having me, Scott. As you can imagine, doing mortgages for 20 years, I basically get stopped in the street every day and people say, Chris, where are the interest rates? Where are the interest rates going? What do you think the interest rates are going to do? With that being said, I certainly can't predict the future. If I did, I'd be a very wealthy man.
There you go.
But, we can always kind of predict and look and see if we can kind of get through these murky waters together and try to avoid any sort of catastrophes, if you would, not to sound too over dramatic.
So with the recent increase of the Fed funds rate last week of another 75 basis points, where does that leave most variable rates right now?
So as you can imagine, it's lifted quite a few things. So to give you a couple examples, you have your student loans, your car loans, your credit cards, which is really scary, and then your home equity line of credits, right? So those are all variable things. To give you a quick example, the credit cards things that's always top of mind to me, because I have a lot of customers that are looking to kind of get away from some of that debt sometimes. So as an example, say a customer's just paying their minimum monthly obligation of $700. With this rate hike, that $700 could now have gone to $900, and that's just a minimum. So, you take your wife out for a nice dinner 3 months ago, and you're still paying that minimum monthly obligation to that credit card. That $300 dinner is now a $900 dinner, right? So it could really get to a point with these rates rising, it's a slippery slope, right? So
And really, all variable rates are contingent upon, where the Fed puts that overnight lending rate, right? So whether it be, a portfolio loan, business line of credit, credit cards, as you mentioned,
student loans,
student loans.
Yeah, absolutely.
So what we're seeing from a lot of people, and the questions that we get asked is what to do about it. What are some of the solutions? And
Sure.
That's one of the questions that I wanted to ask you. What can people do now that rates are so high, and they might be finding themselves in a little bit of a cash flow crunch?
So it's the first loan I ever did 20 years ago. It's called a debt consolidation loan. It sounds exactly what it is. To give kind of an easy example, let's just say a customer owns $250,000 on their mortgage, and their house is worth $500,000, right? And they have 50 grand in credit card debt. What you can do is that you can take your first mortgage, and then what we can do is we pay that off. We pay off the $50,000 in credit card debt, right? And then we start with a brand new mortgage, and that credit card debt is wiped away, zero, gone forever, right? With that being said, with interest rates being so high on the credit cards, it really helps with the cash flow. The other way to go in about it is the home equity line of credit, which in this market is very difficult to get accomplished. Home equity line of credit is a second mortgage on your house. They make it sound a little bit fancier, but it's a second lien position. A lot of banks right now don't want to be in a second lien position.
So they're not doing it, or they're pricing it out.
Exactly right.
Okay.
So it's really difficult to get done. The path of least resistance, if you would really be doing that debt consolidation loan and just getting yourself out of that debt, starting fresh with the understanding that, hey, these interest rates are going to inevitably dip back down, right? And you can put yourself into a much situation and kind of solidify and finalize it once we do see that dip.
And it doesn't necessarily have to be credit card debt, right? I mean, it could be any debt that you have. And what, we've worked together with clients on is, doing the math, right? So, depending upon cash flow and interest rates on car loans or on student loans or on portfolio loans, if it makes sense mathematically to do that, we would go ahead and recommend that. So Chris, what we're seeing from a lot of clients, and the questions that we get asked quite often is, why would I get rid of my 3% 30-year fixed mortgage to go into, where's the 30-year fixed right now?
The national average is 7.3% on a 30-year fixed.
Right, so why would I get rid of my 3% to go into a 7%?
Sure, and I get it all the time. I call it the pushback. I have a 3, why would I go to a 7, right? And for us at Cardinal Financial, we have a bunch of great programs where we can really lay it all out in black and white, right? We can give you an itemization of why it makes sense financially to go ahead and do this and get yourself out of a 20, 22, 25% interest rate, because some of them can be that high.
Right.
What we recommend as well, which I think will be music to your ears, is that we can compose that documentation. And I always say, hey, listen, send it to your financial advisor. See if it makes sense. If it feels right to you, and if the numbers add up, which 10 out of 10 times they do, then usually they come back to me and they say, hey, Chris, let's go ahead and let's pull the trigger.
Yeah, and what's important to understand is that, the nomenclature of a 30-year fixed mortgage is not the same today as it was for our parents and our grandparents, where you're not locked into that for 30 years, right?
Of course.
Most people refinance, every 3 to 5 years?
Yeah, absolutely. I see it all the time. I mean, listen, to your point, 30, 40 years ago, a house on Long Island you could buy for $50,000.
Right.
Now you go out to lunch and it's $50,000 sometimes.
It is.
So it's a little bit different in that regard, but it does make sense financially. And I do implore people to say, hey, listen, get yourself that itemization, get yourself that breakdown. We can do a cost analysis and send it to your financial advisor, send it to your accountant, send it to somebody that you trust to get a second opinion. And normally we do get that feedback to say, hey, listen, this does make a lot of sense. And then, Scott, I think, which we would like your insight on, is then eventually you're going to see that dip in rates.
Sure. So, one of the things that we're seeing from an economic perspective on our end, the research that we get, and I don't know if you see similar stuff, but rates are cyclical. Economic cycles are cyclical, right? So right now the Fed has a mandate to basically go to war against inflation, okay? They need to get prices down.
Sure.
And it's coming down, but it's not happening as quick as they'd like, which is why they've raised rates so rapidly, probably the most since the 1980s, in terms of the increases that we've seen. That being said, much of the data that we're looking at today suggests that the Fed will win this war on inflation. It will happen sometime next year, if not into Q1, Q2 of 2024. And then rates are going to start to normalize again. So the idea would be, if somebody is in a cash flow crunch right now, or they just have debt that they, the variable rates are too high and they want to get rid of.
Sure.
They refinance that. They get potentially some tax deductibility on that now, sure, because you could deduct up to what, $750,000
correct
of mortgage interest, and then potentially refi in 2 to 3 years when rates normalize.
Absolutely. That's the plan. That's what we've been telling everybody. That's what a lot of financial advisors, and I know you've been talking to your customers about that as well. That's what everybody's really doing to try to stave off this inflation.
Great.
Yeah.
Well, I wanted to thank Chris for joining me today. Obviously, we're going to be having a dialogue back and forth because interest rates and inflation are something that's really hitting our client base and customer base, and I think it's an important topic for us to discuss. So if you have any questions, you could reach out to me, reach out to Chris. We have each other's contact information, and thank you.
Thanks for having me.
That's some great insight from Chris Roberti. Certainly if you find yourself in a cash flow crunch or would just like to be a little bit more efficient with your debt, use him as a resource. But where do we go from here? Okay, will my portfolio rebound is the question that I get asked from friends, family, clients, and the like. The answer is yes. The global economy and the US economy has always rebounded from economic contraction or recessionary periods, okay? A bear market is defined as stock indices down more than 20%. But what's interesting to note is that of the last 7 bear markets, 5 of the recoveries have actually produced higher returns than what was initially lost. Meaning if the market was down 22%, the following recovery was up about 27% as an example. So what we do know is that markets will always rebound. We don't have a crystal ball as to say when. However, I get asked from people that are on the precipice of retirement quite often, I can't afford to lose this money. Well, I would argue that you can't afford to lose out the recovery, okay? So making an emotional decision in terms of selling off on your portfolio or reallocating to, what you think maybe you heard from somebody that you trust may not be the best decision. And use us as a resource, use professionals as a resource to help you navigate that, okay? Not only can we help with portfolio construction, understanding economic environments, having a wide angle view on financial planning, but the most important part is the emotional decisions that surround this, behavioral finance and what that could do to overall wealth creation. I've seen it decimate wealth creation, and I've seen it really make a lot of money for people. So again, use us as a resource. Please share this video, and we'll see you next time. Thank you.